So you're interested in getting a mortgage. What do you need to know? What do you need to do? That's what we're going to look into in this video. So in this video here, we're just going to kind of cover the basis of what's expected of you in terms of a mortgage. What are the required steps? What should you keep in mind? Even though you might not be seeking a mortgage right away, what should you start doing to be prepared for it into the future? So we'll take a general look at this, and in the future, if possible, I'll do another video with a mortgage broker, and in that video, we're going to go through the details a little bit more clearly. So the general idea here when you're looking at a mortgage is, first off, you want to get pre-approved. You want to have an idea of how much money you can go and get to buy a house. So for the amount of money that you've received, we'll be looking at the amount of money you received in the last few income tax reports. So that's official. It's not just you saying, oh, I earned $100,000, where the income tax report just shows $30,000. So we'll be looking at that. They'll also be looking at job security, your credit score, and they'll be able to establish how much money you should be able to get. Then sometimes when you're young, you might have to have someone guarantee your loan. So if you don't have a big enough credit history, or the job that you currently have is just kind of starting, so you're not have like many years of high income behind you, well, then you might have to have someone who guarantees your loan. It could be your parent or someone else, so that if you default on your payment, someone else will be in charge, and it's easier for the bank to be safe in that respect. So when we think about all of this, we have to think about it from a bank's perspective. They're giving you money to buy a home. Yes, you normally have to have down payment, and if you have down payment less than 20%, you will have to have a mortgage loan insurance, which is covered in a separate video. But even if they give you 20%, they want to make sure that if you fail to pay, that if they have to sell off the home quick to get it off their books, if they make a loss, well, they have money that they can get from someone else, or they can avoid all of that by having someone else be guaranteed to pay before you go bankrupt and they also go bankrupt and give up on that loan. So if we look at it from a mortgage or from a bank's perspective, they're just trying to protect themselves. And based on that protection, they'll require a few things from a purchase. An inspection is very good to have. They'll look at it to have an idea of how much the value of the house is and whether you're really overpaying for it. If you are, they might not loan you the full amount that you wanted to get. But they'll also make sure that the water is good. You'll often have to do like different water tests or different tests that revolve around the septic system, just to make sure that they don't get bad surprises and you give up on your loan, and in the end they lose money in the process. And then there'll be title insurance if you don't have the proper title. If you don't have a land surveyor who's done a recent report on your property, well, they'll require title insurance to make sure that everything is doing well and it's all protected. So they want to minimize risk as much as possible. So in situations where houses are selling really quick in some heated markets, you don't have access to a land surveyor to do the report quick enough, well, you'll have to get title insurance. So it's just a bunch of things to consider in preparation of getting a mortgage. And like I said, if you want to have good interest rates, possibility and all that, you need to have a good credit score. And how could you start establishing a good credit score as a young person? Well, you could have various credit cards, or at least one, and then every time you have a chance, you could increase the credit to kind of show that even though you have access to many thousands of dollars, you're not using it, you're using it wisely, you're always repaying on time. That just shows that you have access to capital, but you're using it wisely. Cell phone services that are like monthly services that show that you're always paying on time, and all of those extra kind of services that show that you're always paying on time that aren't necessarily prepaid also have a positive impact on your credit score. And then once you get your mortgage, you found your property, you got pre-approved, everything's sorted, everything's good, well, you have to make a decision on what mortgage that you're interested in. So the different terms that you'll often hear in mortgages are whether you have an open or a closed term mortgage, and whether you have a fixed or variable interest rate. So let's go for closed versus open. Well, closed, let's say I have a 5-year closed mortgage. Well, it means that I have a 5-year contract with the bank based on a certain fixed or variable interest rate. And if I were to break that contract, meaning that at some point before those 5 years, I want to sell my property, I want to get rid of this mortgage because I'm selling it, someone's paying me money, and I just want to close the books, well, there will be extra charges involved because I'm locked in. They have a contract with me and they're expecting this amount of interest revenue over the next 5 years. They're locked in, and in the end, you want to leave. If you have an open contract, well, then it's easier to leave at any point in time. But typically speaking, you'll always look at open versus close, and open will require a higher interest rate of you. Essentially, they're paying themselves more to allow you to leave more rapidly. Then when you have fixed versus variable, typically speaking, unless you're in a market where we expect interest rates to fall, the fixed rate will always be higher than the variable rate. It's pretty much always going to be the case because even though interest rates may fall, they don't really expect it to happen in reality. So you have a fixed rate and you have a variable rate. When you have a 5-year, let's say, fixed rate, what you're agreeing with the bank is to say, at this interest, this will be my interest rate for the next 5 years. So even though interest rates may go up during that 5-year term, you are guaranteed to only pay that interest on your mortgage. It's a protection to increases in interest rates. Whereas the variable rate often starts at the discount, could be about a percentage point or a little less kind of discount. And if interest rates go up over this term, well, how much you owe to the bank in terms of interest also goes up. So if I think of an example that I'm paying, let's say 4% fixed rate, or I can have 3% variable rate, and you expect interest rates to go up in the future, which is the case right now and the time that I'm filming this video. Well, you have to ask yourself, well, if they go up in the next 5 years, will they go up in half the time, like let's say in 2.5 years, more or less? And if they go up in 2.5 years and they stay steady for the remainder of the 2.5 years, if I have a 1 percentage point discount, by how much does it have to go up by before the variable becomes less valuable or less beneficial or cheap than the fixed rate? Well, if I started with 2 and the other one's at 3 for the whole duration, well, if I could be at 2% for half the duration, I'd have to be at 4% for the remaining half for them to be equal to one another. So it's always trying to see, well, in how long do I expect interest rates to go up, by how much? And based on that calculation, you can decide whether you want fixed or variable. The thing to keep in mind with fixed or variable, if you were to break the contract before the end, both of them have a different calculation for how much you owe to the bank to break that contract. And I'll have you guys do that as a homework. And that's based in a portion based on the idea that if interest rates are rising, the banks, or if interest rates are falling, the banks are happy to have you locked in at a higher rate. So they really want to keep you for that whole 5-year term. And if you break it, they'll actually charge you for that. So we'll look into that more in person, that whole discussion of breaking contracts, whether it's fixed or variable. And when it comes to a variable interest rate, you have 2 options typically as well. You have one option where the interest rate can change because it's a variable interest rate, but your payments stay the same throughout that 5-year term. Meaning that if interest rates are going up, well, you owe more in interest. Therefore, you, out of that payment each month, there's less that is lowering your capital, which means that after that 5-year term, you've paid off less capital than you expected. And then if you were to have the same kind of rate for the rest of your mortgage, the extra 5-year terms that you keep on adding up till you get to that 25 years, let's say was your initial goal, you would owe more money in the future. Or it could be a variable interest rate where they want to lower the capital by the amount that you've established and the amount that you achieve after the 5 years, so that you get to that level. Let's say you start at 200,000, now you want to get to 160,000 or whatever else owed after this amount of time. Well, in that situation, as the interest rates are going up, your actual monthly payment will go up as well. So your monthly payment goes up or down. So in the end, the fixed interest rate is the most certain one. You know exactly how much you'll owe in interest. You know exactly how much your capital will go down by that time period. You know everything, but you know everything at a premium. You typically pay a premium in terms of interest rate to access this certainty. So that is your big decision between fixed or variable. And in many cases in the past, I found that variable was the best option to use, but I'm not saying it's always the best option, and it all depends on how you feel based on this risk involved, because uncertainty leads to a certain level of stress, where certainty is just nice and stable for this whole time. I know what to expect, and I could better budget my decisions in the future. Then in some of the other videos, I talked about the home equity line of credit, which could be combined with the other ones. And at the same time, with a fixed and variable, I've seen people have like a part of their mortgage being fixed, a part of their mortgage being variable, which kind of gets a bit of the best both worlds. You could do that sometimes with a home equity line of credit, which was covered in a separate video. But that home equity line of credit is essentially a line of credit, meaning that let's say you've financed your home, a $300,000 home, you have a $200,000 mortgage. Well, you essentially have the choice to just pay the interest every month, or you could add like massive lump sum payments and lower how much you owe once a year, twice a year, 3 times. There's no limit. It's essentially a line of credit that is attached to your home. So you have complete flexibility. You could pay more in a few months' time. You realize that you need money, you could take some out. You have all of that flexibility, but all of that flexibility comes at a cost. Home equity line of credit, interest rates will always be higher than the fixed or variable interest rates that you see on these loans that are with a fixed payment scheme throughout the whole duration of the 5-year term. So that's the big options out there. And coming back to not the home equity line of credit, but the fixed and variable options, for each of the banks that you're looking at, sometimes they offer the same kind of prepayment options, but something that you should consider is by how much you can increase the monthly payments without facing any fees, and what percentage of the initial contract you could add in the lump sum payment yearly to lower your mortgage without any fees as well. Because I talk in this class about using either a 25-year contract or a shorter term contract, and I often argue that you should go for something longer term, which doesn't stress you as much. It gives you more liberty in terms of some years you might have more money and you want to pay more, and some years you don't want to pay as much. And by using that longer contract, you could effectively make it mimic a shorter term contract by adding prepayment options, so paying more every month. So many banks offer the option to double your payments. So if you have a $1,000 per month mortgage, which is let's say a $200,000 home at 3.5%, you owe $100,000 per month. Well, if you can double those payments, that extra $1,000 that you put lowers the capital completely. Like all the interest rate is already paid by your typical payments, so any extra money that you put lowers only the capital. So it's something to keep in mind. The prepayment options, monthly speaking and yearly speaking, what are the limits? Is it good for you? Does it work out? And it's just something to ask the banks. Typically they offer something similar, but it's something I would keep in mind. So I hope you found this video interesting on mortgages. We'll cover more of this in class and in separate videos. I hope you have a good day. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real life examples. Have a good day.